what they'll say is, look, well, I got $100,000. I need to invest somewhere. Where should I do it? And they say, you need to put an S&P 500 index. You're going to get 11.68%. That's a great return. We're going to keep you in the lowest tax bracket of 20%, and we're only going to charge you 1%, which means you're going to end up with $4.6 million. Well, if I say I've got 100,000 and I'm hoping, and they say you're going to get 4.6 million, you'd probably feel pretty good about that. You said, oh, thank you. Yeah, let's do that. Until you got the rest of the story that you just transferred away 80% of your wealth because of how you did it.
Welcome back to the Wealth Eazy show, where we talk all things wealth, health, and real estate. Today, I'm very honored to have my coach and my mentor back for a second time from Nashville, Tennessee, my coach, Trent Fortner. Trent, welcome to the show.
Thank you, John. What a great honor it is for me to be here. I've had so much fun watching you just explode in this world. So you're creating some great value.
Well, I wouldn't be able to explode if it had not been for your teachings and your coaching program. So my success is your success. So since your last appearance, what's changed in your world or in the insurance landscape?
Um, Changing my world. Well, we've expanded. We've had a lot more people come through our coaching program. Some of that obviously has to do with you and
Mhm.
your experience. We have. I've been invited to speak at a lot of different places over the last year, so we've probably been in front of 20,000 people since I was with you on your last show.
Yeah.
I've had a lot of people reach out to me who have watched your show and watched our episode and definitely have read your book, and they're just glowing. I think you've got to speak to a few of them recently, so that's exciting.
Yeah. No, very exciting. You've coached hundreds of advisors across North America. What do you think the biggest misconception you still see with clients and even advisors holding about life insurance?
Let's start with clients first. So a lot of clients I don't think have really been educated on how valuable I'm going to say whole life is. There's different types of insurance. That's life insurance, really three different types. And there's a lot of new information that's new to the public because of media, social media per
Mhm.
se. Not all of the information is being vetted the way it should be. People are taking some actions without really testing and getting to know how it helps them. I think that there's some phenomenal, I've enjoyed watching what you're doing, some phenomenal information that allows people to learn to study more about what is the reality of life insurance and how does it fit in their world. Lots of different reasons to own it. I say some people think that it's an investment. I don't see it as an investment at all, but I think it is the tool to get into investments that can be extremely helpful. I also see a lot of people say, well, I don't need life insurance. I've heard that now for 40 years. When they retire, they're saying they don't need it when they retire. And there's a part of me that agrees with that, that says, you don't need it to replace income that you were earning previously. But if you knew what I knew about life insurance, you would want as much as you could get, equal to the size of your estate, so that you get to enjoy more of the money you accumulated with less risk.
Mhm.
That's a very powerful statement that people need to be able to see. I don't, you have real estate, and do you see you canceling your homeowner's insurance when you retire?
No, not at all.
If you did and your home burned down and you're retired, where would you have to go to get the money to rebuild it?
My retirement funds.
Yeah. So that would take away from your livelihood and how you would get to enjoy life because you didn't protect an asset. Whole life insurance becomes asset insurance. So everything that you've accumulated up until that day you slow down or sell your business or change how you get paid from working hours to assets paying you, I would believe I would like to protect it from everything that would take away my options. So if I have a contract that says I'm going to replace what I use when my life is over, my family would be in a much better position. I don't think that's being taught enough. We spent a lot of time in that conversation.
So I'm really glad you brought that up because I get trolled a lot by Primerica guys,
Mhm.
and their biggest thing is whole life insurance is a scam. You only sell it because of the big commissions. You were raping American families, the middle class. Buy term, invest a difference. Buy term insurance. I was on Matt Sapala's IG live last night. The Jays had just finished, and I was, just going through my Instagram. And I saw Matt was live, and so it says, if you request to join. So I requested to join. I've been on his live before, and as soon as he saw me on, and he jumps right on. He accepts me. He's like, my dog, my man, John McGuire from Toronto. What's going on? And we were talking about, what $100,000 does today. And he was talking about term insurance. And he has the same problem when he posted something about Walt Disney, how he was able to create what we know today as Disney World, because he was turned down by the banks, and he was able to borrow against the cash value of his whole life insurance policy. So he made that post, and he said that he got trolled by Dave Ramsey followers and Primerica guys saying, "What a ripoff! Buy term, invest the difference." And my response was, term is not a bad product. It's just got to be used in the right scenario. And you cannot use term insurance for estate planning purposes. Why? Because 98.9% of term insurance won't pay out simply because it gets too expensive and they either lapse or they terminate. So you brought up a really good point that protecting an asset and maybe not so much um, you need the income requirement, but you did say you still want to protect that asset into retirement. The problem with term insurance is that there's a very high probability that it's not going to be there to protect that asset when you need that. Do you agree?
Oh, I definitely agree. Um, that's been a challenge in the industry for a long time. So when those guys start attacking, typically they say buy term and invest the rest. The question would be, where are you suggesting I invest the rest? That's one
Mhm.
thing. And then I would always want to ask them, well, I don't talk to them. I don't, because if they are attacking a strategy without seeing the full context, then it's not a very strong attack to begin with. So what I would want is to talk to the client about what would blow this plan up. And, we have a way of demonstrating that. What I've learned in my life, looking back, I'm 60, I'll be 61 next month in a few weeks. And looking back at a 36-year career here, I've had people who have decided to buy term insurance to protect their income when they're younger and they grow and invest a lot of the money. And I've had people who chose to add value through permanent insurance and term insurance to protect their human life value. And I've had people who've had it all whole life and not really invest in the market as a direct front door investment. I'll describe that in a moment, but to find ways to enhance their life. What I've learned is you need a plan that will work under all scenarios, not just when things go as expected and go right. And I'll show you a calculator in a moment. We hear all the time, invest S&P 500, invest, protect for term, cancel it when you no longer need it, and you'll be self-insured. That's what America says. But there's a lot of things that could go wrong there. So if I got sued, I'd want to know my income and my assets are protected and can continue to grow. If I got disabled, I need to know that my deposits will continue, even if I can't work to make it happen. Without rating my accounts, I need to know that I can position my assets so that I don't get rated by fees and reduce enormous amounts of wealth transfer to other institutions. I need to know that when I have to pay taxes, whether I pay them as I go or I have to pay them at the end, that I'm paying the least amount, not the most amount,
Mhm.
or that I don't have to choose to not take my money because of fear of the tax, which is also a tax, by the way. If I can't use my money, what's the value to me? So I want to position it so that my life can work in all of these things. There's other things that happen, right? We have a lot of new inventions that are coming into this world that we don't have yet, that once we buy one, they'll become a necessity, not just a luxury. Think of how many cell phones you've had, all the upgrades, how many laptops. The fact that we're able to do what we're doing right now is pretty amazing. The first time I had video conferencing, I went to Kinko's and I paid $25,000 for an hour to be able to do what we're doing for free right now.
That's crazy.
Yeah.
That's nuts. Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Easy Show. You know, Matt Sapala, he said it perfectly last night. When you've got guys like Primerica and Dave Ramsey crapping down on whole life insurance and saying you're an idiot, and I've heard Dave Ramsey go, you're an idiot if you buy whole life insurance. He's talking about policies that are 30 years old. They're archaic. Like, you know, he's trying to sell a pager in a smartphone world. Things have evolved. Policy designs have evolved. The break even is no longer 14 or 15 years. I just wrote an application yesterday with a business owner. He's doing a $500,000 annual premium. And my illustration shows that in the first year, his cash value is $489,000. So how's that possible? It's because of how carriers have evolved with their products. And you need to have I believe the advisor doing the right thing and not taking, you know, a $500,000 annual premium, putting it all toward death benefit. This wasn't about insurance. It's about, how do I build up this cash value? How do I move money out of my corporation on the most tax efficient basis, grow it tax free, and get access to it tax free? And the way to do that is by overfunding a whole life policy and structuring it in such a way that it does build the cash value. I mean, the guy's in the fourth year, he's at break even. So here's the problem. I think on paper, and it sounds logical when you talk about term insurance, it's cheap in the beginning and then invest the savings. So why doesn't it actually work that way in real life?
We'll go through a calculator in a minute to walk through that. But I will talk about a few things you just said. So one, policies have become much more flexible in the last 10 years than they were the previous 30 years.
Yeah.
But I'll tell you that I have policies that are 30 years old that are performing better than some of the new ones that I have because of all the years prior, and how strong the dividends are and how much cash is in there. I would not, and I'm not an agent. I'm not selling policies these days. I coach advisors who do. So every day I get to see all these different options of different types of policies and pocketbooks. And so I still work with the advisors and their clients. And one of the things that has become just right in my face over and over and over again is that I hear advisors say over and over, you need to build the policies so you lower the commissions. And I think all of us need to quit saying that. And let me tell you why. If I create a strategy for you that enhances your performance, that guarantees your deposits will continue even if you get disabled, that you are now funding from a place that you couldn't really access money before, and now you can access money, it's sort of irrelevant if there's any real early cash value if it wasn't there before. If you need it for a new reason, then we need to build a whole lot more earlier. But even the policies that have all base premium, if they're protected, and I'm going to show you one in a moment, I'm going to show you what would be considered one of the worst ways to design a policy by something you just said. And I'm going to show you that it still beats by turn invest difference. It's not about just the cash value. And here's why I say that. We focus on it so that we can use it for other things. The rate of return on a whole life policy is going to be somewhere between 3 and 5% on cash value. no matter how long if you hold it a long time, that's about what it's going to be, 3 to 5%. Nobody gets excited about 3 to 5% unless you just saw a big drop someplace else. What I do know is we can turn 3 to 5% internal rate of return to a 14, 15, 18% or higher because of external costs that we recover and the certainty of growth and the fact that we have access to the money to be able to move to take advantage of changing markets instead of having all of our money sit someplace and get attacked by changing markets.
Mhm.
That flexibility is worth a lot. But if John, if I added over $1 million to your life and it didn't cost you anything out of pocket over what you were spending before, if it added $1 million to your life, would you care if I was the agent and that institution paid me $1 million commission for a referral fee to bring it to you?
I wouldn't care.
So you make me too, right?
Yeah.
So the focus should be on what is the benefit to the customer, the client, the member of your practice. What are they trying to achieve? And then design it towards their cash flows, their desired outcomes, and the fact that either they're going to work with you to get an advantage for owning it, or they're going to try to do it on their own and they need some certainty that they're going to win. Is that helpful?
Absolutely. And my response to these guys like Primerica who accuse me of selling a whole life policy just for the commission, my typical response is number one, um, would you rather pay a one-time commission or do you want to pay a management fee over the next 40 or 50 years on the assets? Because I can tell you right now, you, Mr. Primerica, and I'm not shitting on Primerica. It's just those are the guys who seem to troll me and leave all these ridiculous accusations. So I'm gonna use Primerica as an example. Um, you guys are buying, you're selling the idea of buy term invest the difference. So I mean, you're trying to get them to invest with you and buy mutual funds, which the average mutual fund, the equity fund that I know is the average fee is about 2.6%. So you're getting paid. And if you're not doing that, then you're going to charge at least a 1% management fee. And that's going to be on the growth of the assets over the next 40 or 50 years. So you've got the client paying you a commission every single year for the next 40 or 50 years. And you're shitting on me because I got paid a one-time commission? Come on, man.
Get that in a moment. It's it's pretty incredible. I would say that what the client deserves is full disclosure. And I've never had any problem giving full disclosure of what their choices are.
Mm-hmm.
Commissions are not what's bad. Products are not what's bad. Term insurance is a great product for a short-term strategy. It is a terrible strategy. Buy term and invest the rest is a terrible long-term strategy. It guarantees losses and transfers of wealth. That's not my opinion. What they're coming at you with is typically opinions.
Oh,
I
but
only
Trent,
deliver
Trent,
the
Trent,
facts.
wait. The S&P over the last 40 years has averaged, 9.9%. How can you say there's going to be losses?
Let's go see. You want to do that?
Let's
Let's go to a
let's
calculator.
go see. Let's go see.
Let's go see the truth on this.
So
So I'm
so my
going,
response is go, come on, man. I go, listen, if you really were a true financial advisor, you would understand the difference between average returns and actual returns. They are not the same.
let's go look at a calculator. So I'm first, I'm going to go to, I'm going to use a software that you're familiar with. It's called the LEAP system.
Yeah.
And the LEAP system is a holistic financial model that allows us to measure everything. Um, I'm going to do a couple of different stories with this same calculator. Can you see it on your screen?
Absolutely. Yeah.
Okay, so the model that we're looking at is called the PSNG model, and that stands for protection, which is this top 9 drawers, savings, the next one, and growth. Now, I only put a couple of facts in for this client. We're talking to Richie Rich. Richie Rich is 35 years old and he earns 300,000. I'm not looking at anything else in the conversation about how he's protected the rest of his assets, if he's married or not, if he has kids or not, if he has debt or not, if he has other assets. Not looking at any of that right now because we're talking about this buy term and invest the rest strategy. All of those other things are extremely important when you make a financial decision. What the model does is it allows us to take a look at how is money growing? What are the choices? What can we do to make this perform better? And here's the example I have. He's bought a $1 million term policy that is a 30-year level term policy. So in years 1 through 30, from now to age 65, he's going to pay the same premium, $1,500 a year for a $1 million term policy. Can we find it cheaper? Maybe. Can we find it more expensive? Maybe. Doesn't matter. Whatever it is what it is. But what we do know is on day one of after the 30 years, this $1 million becomes zero. He outlived it. The term has expired. If he's healthy enough to renew, and if they offer it, the premium won't be $1,500. Premium's gonna be close to 32,000, 33,000.
And that's why 98.9% of these term policies don't pay out because they're too
Right.
expensive. They cancel them.
Yeah. The majority of people are living beyond 65.
Yeah.
So they cancel. They outlive the term. Now, on this example, I'm going to go to my calculators now. 18,500 is what this person is putting into a portfolio of growth, a growth portfolio. So I'm going to look at 2 or 3 different mixes here on this portfolio. We'll take out my expenses for a moment. Sorry. I got ahead of myself working on this earlier, so we're going to do this backwards. Put zeros there, zeros here.
So you're putting 0% management fees, 0% zero death benefit, actual cost.
Yeah.
You're putting zeros. There's like no
Yeah.
costs.
No costs right now. No costs.
Yeah.
So, and let's say there's no market volatility first. Let's talk about 2 things. Inflows, turn the historical returns off. Now, here's what we want to say. This gentleman, you see, age 35 to 65, is going to make deposits of $18,500 every year from now until age 65. Now, we got to assume something there. When he makes this decision this way, he's assuming that he's going to be healthy enough to work to be able to produce an income that allows him to do this. That's a risk associated with investments, by the way.
And
Not
by
just
the way, this cannot go into a Roth IRA. You can probably only do maybe half because you have limits on Roth IRAs, right?
That's right. In the States, if you're contributing to a Roth IRA, one, it's contributed. He can't do it because he's earning $300,000. So he's excluded from being able to make ongoing deposits for a Roth.
And so same in
Okay.
Canada, it's a TFSA. Same principle. You can't put more than $7,000 into a TFSA.
Yeah, right now the state's at 7,500, but if you earn over, I think it's 192,000 or 168,000. I forget what the rule change was, but it's that range. Then over that, you can't contribute at all unless it's in what's called a Roth 401k. That's an employer offered one. Then you can go up to 24,000, I think, close to that, but then you don't have access to money.
Right.
All right. So let's look at this particular gentleman. He's going to put $18,500 a year into this portfolio. And if he earns no return, he's put in $555,000. Okay. No return, no interest, but we're not putting in for no return. We're wanting a return. So you said earlier the S&P 500. So let's go look at the S&P 500. That's a large cap. 1990 was 35 years ago. So the rate of return, the actual rate of return was 9.62% when we include volatility, because the market didn't always go straight up.
Right.
There were some down years. Not a lot of down years from 1990 to now, but there were some.
But let's just say what I'm seeing here, the average return was 11.45, but the net return is 9.62.
And that's just because of market volatility. Let's see what that means, though. Okay. Let's turn off historical returns, because this is what you hear on the radio from the Dave Ramseys of the world.
The average return, 12%.
Yeah. So let's put that 11.45. That's pretty close to 12.
Yeah.
Right. So then I'll show you something else. I'm 60, I'll be 61. So I'll show you 60 years as well. So 11.45% every year with no losses, which is what people think about when he says average, would result at $4.4 million,
In 30 years.
in 30 years.
Yeah.
Now, if we include, what I'm going to talk about here is what's called wealth transfers. If we include the actual performance during that time frame, there's the 11.45 average, but because of market volatility, we had some down years. Now we only have 3.1 million.
And just for my listeners, because if you're listening to this while you're driving or working on the gym and you can't see this, that's over a 16% differential.
That's right.
So it
That's
dropped
right.
from 4.45 to 3.1. So that is, guys, don't get confused when people talk about average returns. It means nothing. Its actual returns is what you need to focus on.
That's right. And in this example, a 16% differential is a $1.3 million transfer to somebody else.
Yeah.
Okay. Now we haven't added our
Fees.
next piece, which you mentioned a moment ago, an expense. Now you said, what did you say was the average?
1%.
Okay, let's use
1%
1%.
management fee. Yeah.
1% management fee. All right. John, I'm going to ask you to do a calculator for me in just a second. There's $3.1 million in here right now. 1% sounds like nothing, right?
Right.
See, I'm going to put 1% in here. 1% dropped my asset value in 30 years from $3.1 million to $2.5 million. So I had a $600,000 decline. Is that correct? Let's see. Let's take
Yeah.
the zero back out. I think we'll go back to zero. It was 3.1. I put the 1% fee in. 1% is now down 2.5. So there was $600,000 of wealth transferred, but the fee that we paid was $207,662. No, hang on a minute. How much of my own money did I put in here? 555,000. But I paid $207,000 in fees.
Right.
But
And
I think
and
so
and these
paying
guys
1%.
and these guys are crapping down on us for collecting a one-time commission on whole life, and yet they're robbing these clients of over $200,000 in fees over 30 years.
If the premium here, John, was $18,500, if that was the whole life premium, and let's say you got paid 100% of that for your commission, you're comparing 18,500 to 207,000.
Not a good comparison.
Full
Their
transparency.
argument is dead.
It's done. Because first of all, what their argument is a lie.
Right.
Okay, let's go a little bit further. If this is a taxable account, let's say it's not in a 401k, it's in a non-qualified growth stock mutual fund. I'll tell you why I'm using that in this example in a moment. And it's important that we know what your options are.
Yeah,
If
in
I
the
do
U.S.
that,
that in the U.S. that would just be an IRA, an investment retirement account, or in Canada, just a regular registered or non-registered taxable account.
yeah, this is not even an IRA, it's just a mutual fund portfolio,
Okay,
non-qualified. An
non-registered. Okay,
IRA, yeah, the IRA in the United States is a tax deferred growth asset,
okay,
but you don't get the deduction for the deposit. That's the difference. So here it's just no deduction for the deposit, and you get taxed as you go. So how do you get taxed? In this type of environment, you only get taxed if there are gains. Now, in a mutual fund portfolio, you're going to get taxed if there is portfolio turnover that's required by the fund managers. In the prospectus, they have to turn it over to create gains and move the portfolio. It's called an open-end mutual fund. When that occurs, then they have to have portfolio turnover. And it's going to be somewhere between 70 and 90% of the portfolio where shares have to be sold, bought, all these things within the portfolio. The investor does nothing. The management firm does. The broker that places them in the funds doesn't do anything. That would be the American funds or Vanguard or whoever that's doing that. So when that occurs, in the years that they have profits, whether that's interest, dividends, capital gains, they would have to pay a tax. Now, our tax rates, this guy's $300,000. He would pay a 24% marginal tax rate at $300,000. I'm going to do less than that. I'm going to say 20%. We said 20% is a low tax rate. That's our capital gains rate. If I paid taxes from a separate account, not this account, then I would pay over that time frame, I would pay 555, almost 555,000, $554,917,000 in taxes. Now I want you to just the taxes. I want you to pay close attention to something. How much of his own money did he deposit over 30 years?
Yeah, it was it looks like for 500, is that 585 or 535,000
$555,000 of his own money was deposited into the account
after tax money?
after tax money. And now he has to pay another, write a second check, right, to the federal government to pay taxes for 554,917. Let's just call it the same number, $555,000. And then he also gave the fund manager another $207,000 in fees along the way.
Mhm.
So right now, to get $2.5 million, because this is what it says it would grow to so far. And this is not the end of the story, but so far, to get the $2.5 million that says that's what the statement says is in his account, he would have to give up $760,000 to the fund manager and the government, and he would have to deposit $555,000 to get there. So at the moment, it's 1.3 to get 2.5 at the moment.
Mhm.
Now, why am I saying at the moment? Here's why I'm saying that. If I'm paying my taxes from a separate account, meaning I'm not selling these shares, I'm not liquidating this account to pay the tax, I just go over my checking account or I take it out of my income, then that means if I paid the government a tax, then I also lost the ability to take those tax dollars and invest them in this very same portfolio.
True.
That's called an opportunity cost. That's a fundamental principle of economics, but we don't talk about that much. I bet there are other advisors don't talk about that in the world of personal economics, and it's a real cost. So let's see what that would be. Here's how I would figure that out, John. If my net return at the moment is 8.53% in the portfolio because of volatility, expenses, and those things, then what I would have to say is my cost of money on every tax dollar I give to the government and I don't have the option to put here, the cost of money would be 8.53%.
Makes sense.
That,
Yep.
that means now from a separate account, because I paid $555,000 worth of taxes, it cost me $1.3 million in additional wealth because I wrote those checks.
Because that's the actual tax cost plus the lost opportunity cost of what that 550 or 5,000 would have earned you.
That's correct. That's if you pay it from a separate account. But for simplicity,
But how many people actually have that kind of money sitting in a separate account to pay it? Not many.
not many. That's why I tell a lot of people you're probably not wealthy enough to invest this way. But Trent, it's only 18.5. That's less than if we did included the term costs, 18.5 and 1,500, that's $20,000. That's 15% of his gross earnings right now. 15%. He does not, he's not wealthy enough. He's not earning enough to make this decision this way. Let's say he paid it from the account though, John. That's people say, well, let's say he nets it. So let's do that. I got a button here. Let's do that. And let's give him credit for losses. In the years that he had losses, no taxes. Well, now I'm down to $1.5 million in the account. $1,582,000. I'm still not done. The term and invest the rest deal, I had to go spend my own money. And I got $1 million worth of term insurance. Or Richie Rich did. I didn't. 10 million. Let's do 1 million. He had $1 million worth of life insurance. And his annual term costs for those 30 years were $1,500, which also had a cost of money to that because the life insurance is no longer there at the end of 30 years. It's zero. So he lost all of his term premiums at the cost of money rate. So now it goes down a little more. Just another cost. It's $45,000 worth of premiums, but the $45,000 worth of premiums are going to cost him about $85,000 in wealth premiums plus opportunity cost. And it's going to cost him income from this portfolio because on the day after it expires, he had or in this case, 1.5 million in the account and $1 million. And the day after it expires, he only has $1.5 million in his estate because the life
Yep.
insurance is no longer there.
Yeah, it's gone.
So now the portfolio has to be the life insurance, the legacy, and the income, and it's got to pay taxes, and it's got to pay health care. There's a lot of pressure on this money for the remainder of his life. John, the cost of term insurance doesn't expire when the policy does. If he lives to age 85, then the $45,000 worth of premiums, let's just see what that is. I'm going to go to what's called a future value calculator.
And that's just $1,500 a year for the next 30 years.
Exactly right. Future value. Let's see what that really means. So here's the annual payment of term premiums, $1,500. He's going to do that for 30 years and then stop, right? Not going to do it anymore. And we said that there was a cost of money because of the investment portfolio he already chose of 8.6%.
Right. We're
So
not
the
choosing it. We're just using historical returns. This is not a number that we just pulled out of the air. We're using actual historic returns because, guy Dave Ramsey said you can get this in the market. This is what the S&P has done over 30, 40 years. So we're just taking those actual returns, not average, actual returns, and we're using that as a cost of money.
That's correct. So the 45,000 of premiums up until age 65 cost him
Wow.
$206,128.
And
But
that's had he invested that $1,500 into another account that gave him 8.5%. It's
that's right.
200,000.
That's right, 8.6. It would have grown to $206,000. But Johnny's going to live another, let's say he lives to 85. That's 20 more years. So now what I'm going to do is I'm going to take the present value, that $206,000 that we know it cost him in taxes and opportunity costs.
Right.
And I'm going to say it stayed there for another 20 years. He didn't spend any more money. He did not make any more payments. He lived 20 more years. He did not receive the term because it became zero. He didn't cancel the cost though. The cost of the $206,000 one time from the next 20 years at 8.6 would have been $2.5 million.
The actual cost to this person over 50 years was $2.5 million. Just for my listeners, I want to break this down for you. When someone's trying to tell you you should buy term, invest the difference, this is why this doesn't work. Because after 30 years, if you're still alive, you're going to lose the $1 million of term coverage. Now you have zero coverage and you've lost that $45,000 that you paid over the last 30 years. But we have to factor in that lost opportunity cost of if you took that $1,500 a year and put it into an investment that got you 8.5% return, that would have been over $206,000. Now, after 30 years, if we take that $206,000 and we just let it grow, we're not making any additional contributions to it at the 8.5 return based on historical averages, that grows to $2.449 million. That is your actual cost.
Well, it's almost your actual cost. What else do we lose?
We lost the insurance.
That's right. The death benefit of another $1 million.
Yeah, that's wild.
And that's truth. That's not opinion. There's no opinion associated with that.
No, this is math. It's right there. It's plain and
Yeah.
clear. It's on it. That is real math. This is not any one of us making this up.
No,
Math doesn't lie.
no. I'm gonna go back to the first little calculator we had for a moment. Now, how long do we manage money, John?
50, 60 years. If you start contributing at 25 and you live to 85, that's 60 years that you're managing money for.
Okay, let's do that. Because this is important. So I'm going to use this. We're going to use the same thing we did a moment ago. I'm just changing the ages from 25 to 60 years would be 85. I'm going to do something else. I'm going to say we weren't putting money in every year. We just did it once. I'm going to make this right here, this calculator I'm about to show you, the reality of this calculator I'm about to show you has brought more CPAs into this conversation, chartered accountants, CPAs, attorneys, to our side of the conversation from anything I've ever done. Here's a reality of this too. So let's say this person on the inflows had one time they received $100,000. One time. They didn't add any new money to this portfolio. Maybe they inherited it. It was $100,000. I'm going to go and I'm going to take everything out we did before. And I want you, I'm going to ask you to do a calculator for me in just a second. But we're going to go back to that very same story because here's what we get when we go to all of these prospectuses. Make sure I cleared everything. Take out this, take out this. No withdrawals. I'm going to take out historical rates, take all this out. $100,000 that you inherited at age 25 was in the market. And you went to an investment broker and said, hey, I just inherited this money. What should I do with it? And if it's a salesperson who doesn't really care about really talking through what everything you should think about is, they'll say, hey, you ought to put it just in this S&P 500 index, get the highest rate. We'll manage it for you. Leave it in there forever. You'll do great. And then they show this mountain chart that looks like this. And if that were to occur, this is before we add in all the other volatilities, expenses, and everything. If that were to occur, I want you to notice something. For the first 23rd, it's 2025, all the way to 2060, that's 35 years. At 2070, our 100,000 has grown to 14 million. But from 2070 to 2084, 14 more years. 14 more years, it went from 14,000 to 66, 14 million to 66 million. All the compounding's on the back end, right?
Mm-hmm.
All of it. It more than doubles on those last 10 years. If we have losses anywhere along these first few years, first 30 years, first 40 years, then we never get to that explosive phase at the end. We never get that. But the mountain chart in the prospectus will say X in very fine print. It's like page 9 or 10 of every prospectus. In big bold letters on page 1, page 4, and about 7 other times, it says past performance does not guarantee future results. They have to say that. Then they write the prospectus to tell you how risky it is and how dangerous it is and why you shouldn't put it in there. Nobody ever reads it. And then they show you this big mountain chart. If you were to earn this rate of return over this many years, this is what you would get. In small fine print, it excludes taxes and fees.
Mm-hmm.
Well, we don't want to exclude that. So let's talk about wealth transfers. We've got $67 million available at the end of 60 years of our life that we've managed. Maybe it's in a trust. Maybe it's going to go to our kids or our grandkids or whatever. But we left it there and let it grow. But then we find out that because we put it in that fund, it didn't just go straight up. It did have rates of return. So now we're going to look at what was the large cap all the way back to 1964. I know that because that's when I was born. That's 60 years ago. It'll be 61 here in a few weeks. We'll go to 1964. There's that 11.68% rate of return. That's the average that we talked about. In 35 or 30 years earlier, it was 11.45. Now it's 11.68. But look what the value would be, John. Now it's 35.8 million versus 66 million just because of market volatility.
And that's almost half.
Almost half. Now we're going to go apply the expenses. Here's that 1% management fee, right down to 36 million. 1% management fee drops it to 19.5 million. So what I would like for you to do is take this number, and we'll go zero again. You've got 35.8. The new number after expenses is 19.6. So we've lost what, $16 million to
Yeah.
fees? As a percentage of 35 or 36 million, how much did it drop?
It's close to 50%. It's not quite
Yeah,
50%. It's in the
like
40,
42.
45%.
That's right, 45%. Doesn't that sound like more than 1%?
Yeah. But that 1% is compounded.
Right, it's coming out of the portfolio at the gross rate.
Yeah.
And that means it's transferred away from you. Does that mean that the management people got 16 million? No, it means you lost 16 million because of the fees that they got on the 1%. Now, if I knew how to play the game, wouldn't I want to find ways to reduce it? Then, John, I had taxes I had to pay, but let's stay in that low tax rate again. Let's stay 20%. If I paid taxes on this from the account as I go, now I'm down to 4.6 million.
From 66 million added
Yeah.
in taxes and fees alone. And that brings it from 66 million to 4.6 million.
Yeah. Let me tell you what's dangerous about this story. What's really dangerous. You and I are seeing the backside of what happened behind it. But the dangerous part is the consumers don't see that. What they'll say is, look, well, I got $100,000. I need to invest somewhere. Where should I do it? And they say, you need to put an S&P 500 index. You're going to get 11.68%. That's a great return. We're going to keep you in the lowest tax bracket of 20%, and we're only going to charge you 1%, which means you're going to end up with $4.6 million. Well, if I say I've got 100,000 and I'm hoping, and they say you're going to get 4.6 million, you'd probably feel pretty good about that. You said, oh, thank you. Yeah, let's do that. Until you got the rest of the story that you just transferred away 80% of your wealth because of how you did it.
But the story goes even further. Think about this for a second. You put up 100% of the capital, you took 100% of the risk to get 4.6 million while your advisor over or the company that he works for, that company over 60 years got $16 million. That is it's close to a 400% increase that they got and you didn't, yet you put up 100% of the capital and took 100% of the risk.
This is when I ask people if what you knew to be true turned out not to be. When would you want to know about it? This whole story, John, is not really about math. We use a lot of calculator. Problem is, this is about control and who controls the money. Consumers are taught by the big three financial institutions, which banks, Wall Street, and government, on how to play a game.
Yeah.
But that's not the same game that they follow. They teach us rules to give them our money on a regular basis for as long as possible. And then when they give it back, it's in as small increments as possible over a long period of time as possible. Now, I'm 100% for capitalism. I'm very much against confiscation. And if you're playing a game that you don't know the rules and you don't know how to make adjustments, what chance do you have of winning?
And this is happening every single day.
Every single day. It's about control. Here's three things. We all live until we don't. We got to know that. And we got to plan for that part. And if we protect it right, then good things will happen. I want to go back real quick, and I know we're running out of time, but I want to show you something that was the life insurance part. If I had swapped where I put the money, if I had put the 18,500 that was going into the portfolio into the whole life insurance with no early cash value, this is more focused on death benefit than it is the cash value. At age 65, make this bigger. At age 65, the policy that is guaranteed to be enforced at that time is $2,319,000. So the estate value is automatically higher. And when that's delivered, that's going to go income tax free to whoever the beneficiaries are. Now, there's been cash building along the way. Along the way, and I say that way on purpose. So there's $1.1 million in the account that is accessible. Now, along the way, John, all the way up in if the premium's 18.5, in year 4 on this all base policy, the cash value grows right at the premium deposit that year and every year thereafter for the rest of their life. 17.7 in year 4, 22.5 in year 5, and it goes every year thereafter. It's more than the deposit.
Mhm.
Now, the advantage of life insurance versus the portfolio I just showed you is I can access this cash value along the way, borrow against it without removing it from the account so that this continues to grow exactly like this, uninterrupted. And then I can create another cash flowing asset outside of here. So I could literally borrow against this, go invest in the same portfolio and end up with more money because I have money in 2 different places. If I took the $1,500 that I was giving to the term insurance without ever wanting a claim against it and not even wanting the death benefit at that point, the $1,500 would be growing in that other portfolio as well. And it's less risk than giving it to the government or giving it to the insurance company because at least I get it back and I get earnings on it.
And I want to point something out here because in year 5, you've got the cash value at okay, go back there. So year 4,
Yeah.
actually year 4. So year 4. So here's the thing. So year 4, the cash value is 27,905. He put in $18,000. Okay. And the cash value is now 50,427. So that's a difference of 22,522. I want to break this down for my listeners because this is really important here to understand a cash on cash return. You put in 18,500 into the policy, your cash grew by 22,522. If I take away the 18,500, that leaves me over $4,000. That is a 21.7% rate of return, cash on cash. Screw the S&P 500 with their 11% return. This is a guaranteed 20%, 21% cash on cash return. And each year thereafter, it continues to grow. That return gets bigger and bigger because the more years you keep putting in, the cash continues to grow and at a greater return. And this is guaranteed. This ain't bullshit. This the math don't lie. This is something that's guaranteed. It's not based on hope. You're not hoping the markets give you 11%. This is a return. So basically, if I said to someone, hey, if you give me $18,500, I'm going to give you $22,000 immediately. How many times a day would you do that? All day, right?
As often as possible. Now, I want to add 2 other things to this particular contract. If this person got disabled, that insurance company would keep making those deposits for them all the way until retirement age or they died, whichever happened first, just as if they had paid it. No penalty to them. If they had a critical illness, a long-term care issue, or a terminal illness, they would advance part of the death benefit income tax free to this person. Can't do that without liquidating your mutual fund portfolio.
Yeah.
If they live a long life and they make it to retirement, they can stop making premium payments. And now they've got $2 million guaranteed contract that says I can go and spin down that portfolio that I built up to $2 million more aggressively. Instead of just the earnings off of it, I can use the principal and interest to spend it down by age, let's say 85 to 0.
Yeah.
So now when I've spent all that money at 85, now I have the cash value I have access to live on too, income tax free. That dividend you mentioned is income tax free.
So why do you think the buy term and invest the difference idea appeals so strongly to people emotionally, even when it fails mathematically?
One, they don't see the full math, but it's hard to imagine that they're going to get told, well, 12 is greater than 4. 12% is
Mm,
greater than 4%. That's what they're going to hear over and over and over again. And that's only an internal rate of return. Once you start using those external rated return because of the cost and you draw it down, and then you have the inflation. We didn't talk about that. Then you have market management fees. The value of the 12 ends up being more like 2 or 3
right.
if things go the way they hoped. Now, here, when we recover those other costs, if it starts at 3 or 4, remember I said your whole life return, cash on cash, can be somewhere between 3 and 5%. Well, because that's the internal. But because I can recover the term costs, I can recover the fees, I can recover the taxes because I'll lower them. Now my 3 to 5 is now around 12 to 15. And because I can create more income from the very portfolios I was building because of death benefit, now I'm closer to 18 to 20. And then in singular years, as you were saying earlier, as you make a deposit into the contribution of the premium, then you're going to also receive a dividend when they declare the profits to pay that back to you. That is a nothing but a positive return.
Yeah.
Whole life insurance is the only product in the marketplace that is guaranteed to increase every single year, and protected from all those other things. You can say, well, there's IUL, all this. No, those things have expenses that drive it down. Mortality expense. They could have a loss in the market. Let's say, and they say, well, you won't lose your principal. Not true. Because if you have a zero rate of return and you still had a mortality expense and you had an administrative charge, now they're going to take that out of your principal balance. So it would go down. If the indexes didn't recover or they made adjustments, there's no way that those IUL policies will perform the way they originally projected. Not possible. And in my 36 years in this business, I have not seen one do it yet.
Yeah.
An IUL policy.
And folks, we're not giving you financial advice here. We are just giving you an example and an illustration of why a certain strategy doesn't work. And we're not saying to forego making investments into the market and put all your money into a whole life policy. That's not what we're saying. We're just showing you the difference of why this strategy simply doesn't work. Caleb Williams wrote a really great book called The And Asset. I've read it. I know you've read it. I know he's a personal friend of yours, and I've met with Caleb a couple of times, and he makes a really good point that this is a fantastic complementary to whatever else you are doing. If you are doing investments, that's great. This is it's going to complement what you're currently doing. And if you have a fixed income portfolio, Tom Wall made a really good argument that if you've got this fixed income portfolio, even though that whole life insurance is not an investment, it's a really good bond alternative because of the dividends. Like, I don't know what the dividend is in the United States with carriers, but in Canada, right now, the average dividend is 6.4%. I mean, that's a really good corporate bond return, but you're not getting the volatility of the bond, and you don't have to hold to maturity to get that. And if you need to access the money, you're not cashing in the bond to get access to it. You can do a policy loan, borrow against it. Your money stays with the policy. The insurance company is simply lending you their money. So it's an asset. It's not an investment, but I think it's a really good um, asset to add to whatever else you're currently doing.
Names of my friends who I'm working with quite often. So appreciate you doing that.
Yeah.
Um, Here's what I would say to you. We threw out an enormous amount of information here, and your listeners are going to be looking at this and they're going to say, man, that's math. I want to say 3 things. So, first of all, anyone who wants to know how to improve their financial life, reach out to John. We can tell you quickly whether we can help you improve your life or not
Yeah.
using that financial model, the model itself. If you want to know, reach out to John. We'll figure out how to do that. Another thing that I would say is, you know, something that's really important to understand is we use a lot of math right there, but math does not impact the money. What impacts the amount of money you're going to have is life. Life doesn't impact math. If you got sued, that doesn't change the mathematical calculation. What does change is whether you have to access the money or not, whether you have it or not, or whether somebody takes it from you. Math doesn't isn't impacted by technological change or planned obsolescence or death or grieving or adoption or any of those things. But life is. And so what we want to do is help you build a plan, a life that works when everything around you doesn't. What we showed you today is when things go right, when it goes the way they tell you it's going to go, and you still lose. We want to make sure that you're playing a game that you can know you win with certainty because you learn how to play with the rules that are available to you, not the ones that are taught to you by the institutions. And when we take that way, you can win first, then play the game and win with certainty.
You
So
know,
on this bit,
yeah, and thank you for that plug. I appreciate that. And just to ride off of an extension of what you just said, here's another question, real quick. What role do you think liquidity and control play in achieving financial independence versus market dependence?
market dependence is all based on hope, all of it.
Yeah,
And you
and
have
hope is not a financial strategy.
is not a strategy, and you have zero control of that. When you have liquidity, access, and control, you now have some degree of control in the outcome of what will happen, and you get to create what I call the velocity of opportunity. Opportunity finds cash. So if you have liquidity and you have the ability to move, and you have the model to help you make a better decision, then you can decide where to go and whether you'll win or not. That's what's important. Putting you, the client, in control of the game instead of being controlled by all of the factors that come to play. And this is the only way that I have found, the only way I have found to win is to one, know the rules and play with people who can teach you and walk you through it.
It's amazing. Let's do a real quick bonus rapid fire here for to close this out. Term versus whole life in one word.
Term versus whole life in one word. The certainty of winning versus the guarantee of loss. And the guarantee of loss there would be the time.
Most overrated investment strategy.
Wait and hold.
One book that changed how you think about money.
There's lots. One I'll plug quickly. Yours is one of those for sure. Uh, Another one for me was Bob Castellan's book, The
Mhm.
Leap System.
By the way, for any new listeners, my book is called Wealth Without Wall Street, Taking Back Control of Your Money in a Rigged Financial System. And there are a lot of great books. I mean, Garrett Gunderson's got some great books, Sacred Cows, What Would the Rockefellers Do, Mass Money. He's got like 7 books. Like, I love reading his books. Like
Yeah.
that guy is just, and he was mentored by you.
It,
And last question, your personal definition of wealth.
being able to create the experiences in life, the memories of life when I want to, how I want to, with whom I want to,
And on your
without
terms. Yeah.
on my terms.
Amazing. Trent, as always, it's been so great talking to you. And guys, if you think you wonder why I know my stuff so well, it's because of this man right here.
Mhm.
And if you are a financial advisor or if you are new in the business and you want to sharpen your game and ask better questions, reach out to Trent. Trent, tell everybody, anyone who's listening who wants to get personal coaching from you, how to reach you because you have completely changed the way I ask questions and I meet with clients. And I think it's the problem with financial advisors today is it's all in the questions that you ask them. And you
Thank,
taught me that.
thank you for saying that. Thanks for the plug there, and you have lived it out. So you're the a great commercial for how you take the information and quickly apply it to help clients win. That helps you win as well. Best way to get in touch with me for that type of conversation is just go to my website at trentfortner.com
Yeah.
and shoot me an email and tell me what you would like to talk about. And then we'll get you the information you want, and I'll be happy to talk.
Yeah. This has been amazing. Thank you so much for your time for coming on here a second time. It's always been great having you. And I continue always learning from you, even in these little sessions. It's been fantastic.
Mhm. Proud of you, John. Thank you for having me and look forward to doing it again.
Yeah, amazing. I look forward to it too. Guys, that's all for today. If you like this episode, please like, subscribe, and share it with your friends. And don't forget to follow me, John W. McGuire on Instagram. I'm also on LinkedIn, and you can watch this show. And I really encourage you to actually watch this to actually see the calculators and see the math. You can find it on Wealth Easy, EAZY on YouTube. That's all for today. Take care of your wealth and your health.